The Big Money Podcast. It's your window into outlier stocks and what really moves markets. Don't follow the news. Follow the big money.
All right, it is the Big Money Podcast. We have a great show for you today. It's been a long time since we got on the horn together. I am Lucas Downey. I am with my partner, Jason Bodner, and we're going to be discussing some really important topics for you guys. We're going to be covering recessions. I know that that is a huge buzzword all over the media. I'm going to dispel some fears about the recession. Then we're going to go into earnings, right? There was this earnings apocalypse that people were worried about. We're going to cover some facts. And then finally, we're going to get into some data because institutional volumes do matter. That was a lot of words. How are you doing, Jason?
I'm good. I'm sipping on a green juice for the first time, and it's admittedly far more bitter than I thought it would be. So I might have a little scowl, but I'm good. Yeah, we got a lot of things to talk about. It's cool. I say we just dive right in. Why don't you lead us off?
Yeah, so why don't we talk about the big buzzword that everybody is throwing around right now, and that's recession.
Yeah.
We know that people are worried. The economy is contracting. Interest rates have risen, right? Stocks, they are doing a lot better than most people had feared. But, what are your thoughts? Are we heading into a recession? If so, are you worried about a recession?
No, I think those are, top of mind to everybody. And it's a very real concern. However, personally, I'm not terribly worried about a recession. If we do get one, I think it would be mild at best. There are a lot of data points right now pointing to why I don't think there's a recession. And maybe, that's going to overlap with, I know what you mentioned earlier was earnings and things like that. So we can bring some of those up, but, probably one of the biggest things right now is the CPI on the last reading came in so hard and fast, which is a real indication that inflation, this war against inflation with interest rate hikes, is working. And, here we are on the eve. Tomorrow is going to be the FOMC meeting. The decision is going to be released. And I know it's not popular, but I'm almost leaning like they might not even cut it all. I think the wide consensus, maybe 80%, is that there's going to be a 25 basis point hike. And then after that, it's wait and see. Just today, JP Morgan announced they're laying off 3,000 people. You still have regional bank failures.
Was that JP Morgan or was that Morgan Stanley?
I'm sorry, Morgan Stanley. Did I say JP Morgan?
I was like, I don't want to hear more job loss from another bank. Okay. Yeah. I saw that headline with Morgan Stanley. Yeah.
Yeah. Thank you. Thank you for correcting me there. A little senior slip there. But yeah, there's still troubling signs in the economy, but overall, the regional banking stuff still seems to be very contained. FRC was taken over by JP Morgan. That's what I was probably thinking about. But this paves the way for earnings. So I want to get your thoughts on recession first, but this fear and dread of a slowdown, I think it's important always to contextualize where we were coming from, right? If we do have a recession, I don't think it's apocalyptic, because given the level of economic growth we were experiencing, especially during the COVID era, which is so counterintuitive, right? You're going to have a virus, everyone's going to lock down, no one can go to their offices, and then all of a sudden the economy explodes because of free, easy money. Mm-hmm. So now that the Fed tightens the spigot, of course it's going to slow down, but where's it slowing down from? Record growth, So I'm personally not overly concerned about a major negative thing. It might be tough. There might be economic contraction for a little bit, but I think once the Fed pauses, becomes data dependent, and then starts to look at areas of the economy that are starting to firm up without getting overheated, they might even start relaxing rates as early as 2024. So nobody knows, nobody has the crystal ball, but the last thought I'll leave you with is it's my firm belief the Fed's not here to undo all the rescuing and propping up of the economy that it's done for well over 15 years in the span of 18 months. I just don't, their job is to put the brakes on, which is what they're doing.
Right. Yeah, no, listen, we had inflation. They had to tighten everything up. I think most people are feeling that tightness that you ask around. They go to the grocery store, prices are higher. They get gas for their car, prices are higher. But as it relates to the stock market, and I personally do think that we might be heading towards a recession. I think it might be mild. I don't think it's going to be gloom and doom like everyone said. And I think everything that you said, I probably agree with most of it. But at our research firm, Map Signals, right, we've been very constructive, even in the face of potential recession. And I think it's important for listeners to understand that recessions are part of history. I believe since World War II, there have been 13 recessions. Here's the good news. We bounced back 13 times. If that number is correct.
We're still here.
Right? We're still here. And also we're going to have recessions in the future. So we should probably position for them rather than, be worried about them. And listen, we did this really awesome study. This was in December. So December coming into the year, everybody was very negative on the markets. And the study was that recessions aren't the end of the world. And we went back to 1926. You're talking about 100 years of data. I think it's important to have some facts, right? 6 months prior to a recession, the S&P 500 tends to fall 4.6%. Now remember that, it falls 4.6%. Now, during a recession, what do you think the market does? I think consensus would probably say, oh, the stock market's going to fall a lot further. It actually doesn't. The stock market actually falls 1.2%. Okay, so there's a bigger fall that happens prior to recession. Stocks are, I would call it roughly flat during a recession. But here is the kicker. 6 months after a recession, the S&P 500 is up 16.9% on average. And so we have a lot of people, we're in the investment game, we're telling people, here's what we think, here's how you should be positioned. We're not telling them it's the end of the world. There's a lot of people out there that say, you know what, I might just sit this one out. I might sit this one out, wait for lower prices. But based on history, you actually want to be, buying into this dip over the long term because the big payoff is going to come after the recession. So that's a little bit different of a tangent, but.
Yeah, but I want to stay on that tangent. I think you bring up an awesome point. And what was going through my mind was economies and stock markets are often thought of to run in tandem and be the same thing, but they're really not, right? You and I used to sit on the desk and we'd talk about the man always knows. We'd see these patterns unfolding in stocks. It would be at the depths of despair in the great financial crisis, and all of a sudden stocks are rallying and everyone's scratching their heads and don't know why. And we saw such similar action, if we go back, because this is on topic, I think I wrote about this the other day. We were talking in September, right? The market was.
That was the market low or very close to the market low.
Yeah, the market low was in October, but the sentimental low was probably right around there too. And you and I were talking, and we, of course, felt the pressure emotionally, but we decided to do what we always do, is go with data. And the BMI, the big money index, our indicator, had gone oversold. And we know it's such a strong reversion signal. So we're out there telling our people and whoever will listen, hey, we see brighter skies ahead. We pointed to the big money index being oversold and what that means historically, expecting a forward rise. We pointed to seasonality, especially in midterm election years. We had a midterm election last November, and we were, I think you did the study. You go back since 1982, and the return from November 1st to April 30th was an average 13% higher on the S&P 500, with, more importantly, 10 out of 10 years, 100% of the time, the market was higher. Hey, guess what? Here we are now. The market's broadly 15% higher. We pointed to all sorts of buying and selling data for ETFs. And then, what was the most fascinating of all, Luke, is what led us out of that nastiness was technology and discretionary.
Yeah.
These are the growth sectors. So if everybody's sopping up, not everybody, if smart money or fast money is mopping up shares in the growth sectors, what does that tell you for the forward outlook of the market? Going back to that point, the man knows the stock market is a forward pricing machine. And this is what you used to tell me. And it doesn't sink in. It's not intuitive. You want to look at prices and say, how can I make money by the end of the day? And everybody's miserable and the sentiment is low, but stocks are rising. It doesn't make sense. That's because it's a forward pricing machine. So here we are. We've had a 15% rally. The Philadelphia Semiconductors Index is up 37% since the market low on October 12th. That is a sector that is predicated on growth and predicated on consumption in all sectors, because everybody's using chips and semiconductors in their machines and conducting cloud business, whatever it is. So you have these two powerhouse growth sectors leading the market higher. And then all of a sudden, over the past few months, what have we seen in other sectors? The selling has gone away and they're starting to lift as well. And that's even in the disaster that has been financials and real estate. They're trailing. But you look at industrials, materials, staples, healthcare.
Yep.
All those sectors are getting strong. So to me, if you look at the internal structure of the market, it's healthy. And we were talking about this being a likely scenario back when the sentiment was low. And that is sort of the power of data. And the reason why I wanted to stick on that tangent is because you brought up an excellent point. We may go into recession, but stocks may rally. Stocks may rally from here because it's already priced in 6 months from now that they're looking past all this stuff, because when I say they, it's the man, it's the market. They know the Fed can't keep raising rates. They know inflation is cooling. They know we might already be in a recession of sorts, if not in the classical definition of one. And they know it's going to be short-lived. So here we are. Stocks are rising and earnings working, which probably brings us to our next topic. But I think I trampled all over you. I'm sorry.
I think it's good to get
it out.
I think it's good to get it out. We haven't done one of these podcasts in a very long time. So there's a lot of ground to cover. And I think the next one that we do, it'll literally be more pointed. But the other thing is, going back to September, October, I'm always on Twitter. Everybody, and I say everybody, the crowd was bearish, it was end of days, but if we go back, we look at our data, when the whole crowd is worrisome, right? What does Warren Buffett say? You probably want to be, getting your buy tickets out. He doesn't say that, but he has his other, stories.
That's what you say.
Yeah, that's probably what I say. But the last study I want to put here before we get into earnings, because I know you've been doing some research there. We put this out, and I think this is so important whenever the going gets tough, look back in history before you form your narrative, because here is what is cool. The study says that stocks do well after inflation peaks, even in recessions, right? Because everybody's worried about inflation. So here's the study going back to 1955. The S&P 500.
Is something you can pull up on your screen or no?
I mean, I probably could. Let's see here.
I'm sure people would want to see. I want to see.
Yeah, let me see. Let me do
I
this
want to
just for
see it.
you.
I don't
All
mean
right, do
to
you see my
interrupt.
screen here?
Oh yeah, look at that. Okay.
Okay, beautiful chart here. Stocks do well after inflation peaks, even in recessions. This is 1955. I think this is the missing narrative that the media just isn't going over. But here we are now. This is back in December. Okay, very constructive going into 2023. So here's your average return, 14.5%. Now, what is the average if followed by a recession? S&P is up 11.2%. Average if not followed by a recession. So there's a good chance we don't go in a recession. And look, it's double the returns. It is a 21% gain. And
Oh,
so
but
listen,
you just, the one key point, and you just took it off your screen. It's okay. It said the cycle CPI peak was in July of
yeah,
22. I think it was July 31st or something like that. So we can unanimously agree that inflation has peaked. That's the real event here. You know, everybody's focused on recession, but no, I don't know about you. I still feel pain at the gas station, but it's not as bad as it was. Food is still expensive, but it just feels like generally people's spending habits are starting to reflect the inflationary environment. People are cutting back, all those things. So you're pointing out that, hey, stocks do great even after a recession.
they do.
And after inflation's peaks. So inflation has peaked. Here we are, the market's rallied 15%. And you know, I think it's setting up well. I didn't
Yeah.
mean to
And
interrupt you. I did mean to interrupt you, but I'm
no,
sorry.
and I think it's important to know, look, I'm not saying the coast is clear. All I'm saying is that in those weak points where hell is so hot, right? Everybody's worried. Go back, look in data, our data, right? What are the money flows telling you? The story was very bullish going forward. And so after seeing a huge rally that you're talking about, we've got earnings. A lot of companies have reported, and our analyst, Alec Young, has been talking about there is no earnings apocalypse. And he's been so right. What have you learned about earnings? Because I think as the numbers keep rolling out, a lot of people were thinking this was going to be, cataclysmic. It just has not been the case. And we know that stocks follow earnings. So
No, and I think that's such a great point. This is simple. So far, as of Friday, here we are on Tuesday, May 2nd. This is Friday, April 28th. 53% of the S&P 500 companies in the S&P 500 have reported actual results. You would think it would be a bloodbath. 79% of the companies that have reported have beat earnings estimates, and 74% have beat revenue estimates. Now, a couple of weeks ago, things were looking really dire because the estimated earnings decline was going to be negative 6.7%. That was on March 31st at the end of the month. The actual blended earnings decline so far is negative 3.7%.
Yep.
So yes, there is an earnings decline, but it's not nearly as bad as analysts are estimating. And clearly analysts are on the wrong side in terms of earnings and sales reports. Now we still have half of the S&P to report, but you can see really great strength in bellwethers that are coming out, like Microsoft blowing away earnings. You have big consumer discretionary bellwethers like Chipotle. And, I think we own one
company,
or both of those in accounts. We got to disclose that. But Chipotle came out and blew away earnings estimates. I mean, I think it was like 20 billion in revenues. Like, think of all the burritos that are getting sold out there. People are still buying, So I think this is a great example of what you and I discovered so long ago, is that we're emotional beings. Everything is so wrapped up in our feelings and our fears and our anxieties and our desire to control everything. But if we can realize we can't control everything and we can react to objective data, we probably have a fighting chance. And that's sort of what our whole foundation was really built on. And the data, the earnings data, just says, hey, it's not so bad. Buck up, everybody.
While we're talking about this, and I'm glad you brought up the point, earnings are down year over year, right? And a lot of bears are going to point to that and say, listen, there's a problem. Guess what? I'm going to point to another study, because when earnings contract, do you think stocks go up or down on average?
Well, one would want to say down, right?
And you would be wrong. So
I hate being wrong.
Here's another study, and that's what makes this so great. So listen, this is a study. We did this, oh my goodness, I want to say this was late last year. Stocks have advanced even when earnings contract. Now remember, I think this goes back to what we talked about earlier. Okay, stocks are going to fall harder before a recession than actually in a recession, because, as you said, it's a forward-thinking machine, right?
Right.
Bottom quartile earnings contraction. This is going back to 1963. Okay, a lot of data here. Still, the S&P 12-month forward return is 7%. That's in the bottom quartile of earnings contraction. So this is in the very weak periods. Now, as it starts to grow, when earnings do well, or they do better, of course, market continues to do a lot better. But I think this just goes to show that even in a contraction, it's not the end of the world based on history. And obviously, whenever earnings grow, stocks do well. So I think there is just a narrative that is missing based on history, even in contracting earnings. You know, you got to ask yourself, are we at the trough in earnings? That's what the big money is starting to ask themselves. Because if we're at the trough, or if the next quarter is the trough, then stocks are probably going higher, because it's going to be discounting those forward earnings.
Totally. And again, you go back to the sectors that are leading us out. And it's
this is where we pivot to the data, by the way. So this is our final piece. We talk about what is leading us, because a lot of the crowd is stunned at the latest round.
Let's do it. Take us to where we need to go in terms of the data, because you and I look at this stuff all the time, and it's sort of second nature to us. But
the weakest areas last year, the two sectors that got hurt the most, they're the ones that are leading the latest lift: discretionary and technology stocks. High quality stocks. This isn't your garbage stocks. It's not just FANG. A lot of people are like, oh, it's FANG. They're responsible for 50% or something of the S&P 500 gains, maybe even more. But there's a big bull market that's under the surface, and a lot of small cap names as well.
Well, that's something else. We look at the, market cap data, and that's something I can pull up here real quick. Let's see. Share screen. Oh, you disabled me. But I was going to pull up, you can do it on your end. I was going to pull up the market cap distribution of buying and selling.
You can share now.
Pull it up. Oh, okay. In our little portal thing here, we have a market cap component. We got the pinwheel. It's because we use Zoom. It hogs up all that bandwidth. But if we go in here and we look since the beginning of the year, you're going to see a ton of buying. These are all individual stocks being bought and sold in the small to mid cap range.
Are you sharing your screen?
Oh, I thought I was. I apologize. Let me try
No,
again.
That's okay.
Okay, you looking at my screen now?
I see something.
Do you see the market caps?
Yep, there we go.
Okay, so this is since January of this year. So for the first, 4 months of the year, these green bars represent all the stocks that have been unusually accumulated in various market cap structures. So 500 million to 5 billion, we had 1,788 buys. We had 2,247 buys. Now, of course, we see some selling, but this includes March's nastiness. So the selling is very isolated.
And it's
but the
also
buying,
and this just tells you, I wanted to be clear. This may look like, oh, there's just as much buying as selling. It's not, because a lot of the stuff that was getting sold, it's regional banks. So the money
yes.
hasn't been flowing into those areas.
And we can see that reflected here too, from January, right around here, it was buying. And March, we saw that nastiness.
Financials.
What Luke is talking about was
Yep.
mainly financials and regional banks. And you can literally go in here and we'll just pull up the financial sector to prove the point. You can see the level of destruction that took place in March. I mean, this is right when everyone was panicking about Silicon Valley and Signature Bank. This was a ton of selling. So going back to that market cap, a lot of those small and mid caps, the selling was really focused in financials and real estate. The buying was kind of focused in tech, discretionary, healthcare, those growth sectors that we've been talking about.
And the interesting part about this, and then, I think we'll wrap it up, but it's not that you need to see buying for stocks and markets to go up. You really need to see selling slow down. That's the other piece that you don't really hear most people talking about, other than, map signals, is it's not whether stocks are getting bought. It's really, are they getting sold? Is selling increasing or decreasing? And we went out on that because that's really when the BMI started to rally really hard, in the face of all the negativities, because selling slowed immensely. And it really was primarily because of the banks. So anyway, that was a great visualization.
One other thing I just wanted to talk about, I have a chart real quick, and we shared this in a publication recently, was if we look over here, this is an interesting chart. I know it's on Excel, but I took all the data. I went to FRED, the Federal Reserve Board's website, St. Louis, and the dark blue is the Fed funds rate. So that's the interest rate that's going to come out tomorrow. And the light blue is CPI, all items. That includes energy, food, everything. That is the level of inflation. You can see since January of 2020, inflation has been at a huge spread above the interest rate. And now with the recent collapse of inflation, the Fed funds rate and CPI are almost at parity. So that's another really compelling reason.
Very cool chart, because typically whenever that Fed funds rate, just looking at this chart, when it gets above CPI tends to fall very fast. You can see that in 1970s a couple of times, and then you see it obviously in 1980s.
And even here, even in 2006. And even that's the crazy thing, is the Fed funds rate just got to about 2.25% after this long flat line, which was post great financial crisis. And then it was a slow ramping to get above inflation. That's where we were. And then COVID happened and it went straight line right to zero. And that's that balloon effect of inflation with all the free, easy money. So the Fed has had the fastest, most aggressive rate hike campaign in recorded history. That stuff takes time to work its way through the system.
Beautiful chart. And I think we're going to have to wrap up with there.
I was having so much fun.
I know I'm getting one of the dings. We're like, we got to hurry up. But listen, recessions, you shouldn't be worried about recession. I know they're painful. Got to keep your head down. We are going to get through it. And the data says the market isn't going to crash or anything like that. Earnings have been better. much better than have feared. And
Oh,
then the
don't
data
forget,
got
don't
ahead of
forget the one chart you didn't share was, you can also go to Fred and look up cash, money market assets
Oh, yeah.
are the highest on record since 1945. So people parked all their money in cash. It's just sitting there waiting to be deployed. I mean, these are all very bullish things to me. And I know it's unpopular because people are talking about the end of the world and recession, but I just see a lot of positive catalysts to continue to lift stocks. So just wanted to throw that in there too.
Listen, I think that was great. You brought a lot of data to the table. I think that's the most important thing when it comes to investing. Focus on data, facts. And with that, I feel better. So
I feel better too.
yeah,
This was fun. Let's do it again. Definitely give us your feedback and all that stuff. Keep questions coming if you want to hear topics for us to address. But this was great. Thanks for setting it up, Luke.
you got it. And everybody remember, head over to Map Signals, follow the big money. We'll see you guys next time.
Thanks for tuning in. And please remember, this broadcast is intended for entertainment purposes only. Investments can carry substantial risks. Before you make a financial decision, you should first consult your financial advisor.